Hello and welcome to today's premium account market update for November 2019. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 24 years of experience in the financial services industry and a licensed securities and derivatives advisor. The topics for today: we look at the macro update driving equities, we roll through the ASX top 50, we look at FY 20 earnings, we focus on the technical trends, portfolio allocations, and conclude with a short-term Australian market outlook. Our premium account service is a model portfolio based on ASX top 50 or top 100 stocks. We utilise call options to enhance portfolio returns, focused on effective ownership around ex-dividend dates, above average cash flow from the dividends and the call options, whilst capturing capital growth, and in a strict investment mandate, and importantly the assets remain in your name. If you'd like to know more about the premium account service, please call me on 1300 614 002. Moving straight into a graph of the XJO, broadly global equities are well supported by central bank policy, lower rates, and policy measures from global, both central banks and governments, to look to support equity markets. So whilst in the US we've seen very little in the way of earnings growth over the last 9 months, when you look at the average earnings of the S&P 500, as we see interest rates come down, it's providing support to the market. And really, we haven't seen the earnings recession that was feared. There's been some pockets of weakness in the earnings results over the last 9 months, but I think the takeaway is the hockey stick recovery in earnings that was expected in the December quarters probably unlikely to occur. Most analysts have pushed that recovery in earnings out into the first or second quarter of next year. So I think when 2019 is concluded, we'll probably see maybe flat or 1 to 2% earnings growth on average. Share buybacks and low interest rates continue to remain a major support for equity markets, and we think that a combination of a slight improvement in the Chinese economy, maybe a bottoming in Europe from very low recessionary levels, especially in manufacturing, we're probably at a point where the market can trade higher, and that's something we'll review at the end of November, end of December, but we're moving into a traditionally strong period for equity prices. As we move through the top 50, we'll focus on the companies that we have an overweight preference to, and starting with AGL. Whilst the dividend yield's attractive here at around 5%, our concern is the company's just coming off the back of a 15% drop in earnings, and we don't have enough visibility yet. Our base case is that around $20 is full value, so if you're owning it, sell covered calls to drive the extra income, but it's not really part of our core portfolio. Aristocrat, we still remain cautious on this at a 2% dividend yield, and it's not under algorithm buy conditions, so it's not a stock that we're active in at the moment. Amcor, we're attracted to this on the basis of a $500 million share buyback that's about to begin. They update investors on the 8th of November. We think that could be a catalyst where the company provides more clarity around the costs savings post the Bemis acquisition. We're probably looking at a trough low here in Amcor, and we think it can trade back up to around $15.50. AMP not doing it there at present. ANZ, the Australian banks clearly are running into headwinds around margins and cost pressure. They've corrected about 10 to 12% over the last month, and whilst in a soft market we would give them more leeway to the downside, given that our base case is that equities remain well supported, you're probably looking at from a timing standpoint, an opportunity to buy into these banks and have a bounce over the next couple of weeks. But we're just not confident yet that that there's the earnings growth potential to really see them re-rate. But obviously, still at a 5 or 6% dividend yield, they remain attractive. Uh, the bright spot being the recovery in the Australian housing market probably takes away some of that downside risk around, worst case scenario with a recession and falling housing prices in Australia. So with that out of the picture, it becomes more of an issue just around those net interest margins and their ability to control costs. APA Group, it's in the algorithm model. We had a buy signal here at around $10, pushing up to 11.60, but not really a stock that we particularly focus on in the premium account holdings. ASX we like. We see this as a good opportunity in the market, albeit at a very expensive price. So it's getting down to less than a 3% dividend yield, growing earnings at about 5%. So you can see there that I've marked support at just below $80, owning it there and selling covered calls. You're generating up towards 10% cash flow on an annualized basis. AZJ is expensive. We'll take a look at this later in the year or probably early next year. And it's not until we saw a retracement back to sort of 550 that we'd be willing to take a look at AZJ again. Now, BHP, coming into the next week or two, we see upside potential for BHP. So it's a buy here at $35. Combination of better data that came out towards the tail end of last week in China, and a willingness, I think, for investors to add more exposure to emerging markets should also flow through to stronger iron ore prices, which BHP will be an obvious beneficiary of that. So within the Australian market, arguably BHP and Rio, maybe Woodside, probably offer the better upside potential than the banks, albeit I do see the banks finding some support, and our preference being ANZ and NAB out of the banking names, but I'll discuss that more as we move through them. So BHP, add that one to your watch list. Brambles, we like this also within the industrial space. There's not many stocks that you can say are cheap, so Brambles is an expensive name in the market, but with interest rates so low, it remains attractive. So we're just under a 4% dividend yield here in Brambles. Owning it, selling tight covered calls, you're pushing that cash flow up to 8 to 10% per annum. Earnings growth limited, earnings growth is about 5%, 5% top line revenue, 5% bottom line, which is relatively attractive in a market that's delivering low levels of growth. We've been cautious here on CBA. If you look at it over the past 3 years, it's predominantly been under algorithm sell conditions, which are these markers up the top of the screen here, compared to the number of buy signals that we've had. The stock has rolled over and made these series of lower highs through here, and probably out of all the banks, CBA is the one that we're most cautious on at the moment. ANZ's the one that we like. Cochlear, so under algorithm buy conditions, they're at around $200 a share, delivering about 10% earnings growth. Coal's expensive, but again, roughly just under a 4% dividend yield, flat earnings. Buying it, selling call options. From a risk reward, you're delivering almost 8 to 10% cash flow plus the franking credits there. Computershare, we're cautious on this name, see it making lower lows, lower highs, structural issues and competition facing the business, and we see that Computershare could easily trade down to sort of $12 to $14 range off the back of it, the next sort of weaker earnings result to come through. CSL, under algo buy conditions, continues to create a bullish structure here of higher highs and higher lows, growing earnings at double digit, but on just over a 1% dividend yield, obviously looking expensive. Caltex, we avoiding this name at the moment. They're disappointed the market with a recent earnings update. The attractiveness here is just over a 4% dividend yield, but until the stock sort of breaks out of this downtrend and starts to make a higher low, and switches to algorithm buy conditions, we're not doing it there at the moment. Dexus on just over a 4% dividend yield. This is a holding in the model portfolio. Fortescue, again, there's under algorithm buy conditions here, making higher highs, higher lows. Uh, Bullish on iron ore prices, so we could see Fortescue moving higher, but preference is BHP and Rio. Goodman Group, we like the story here, still with the growth within the logistics centres, industrial sort of logistics centres, but it is expensive for a REIT. Trading on just under a 3% dividend yield, delivering about 5 to 8% earnings growth. The stock has pulled back from very elevated levels, but found support again at a higher low, and we just see it continuing to grind higher from where it is at the moment. GPT disappointed the market. If we go back 12 months ago, it was growing earnings at around 5%, 6%. The latest forecast shows earnings growth of 2.5%. So it disappointed the market. But if we just go in and have a look at the activity there towards the end of the week, there was selling as a result of that lower profit result, but it actually traded back reasonably well on Friday. Fair values still at around this $6 to $6.25 level, owning it and selling covered calls, delivering about 10% cash flow there. Insurance Australia Group, steady opportunity here, owning it, selling covered calls. Insurance Australia Group will deliver high single digit earnings growth, and it's trading on just over a 4% forward dividend yield. So owning it here and selling calls up at around 8.25 makes sense. James Hardie, we're not doing there at present. Lendlease, so this is if we switched from sell conditions to buy conditions here at around $13.50, now pushing up towards $19. May have a little bit left up towards $20, just given sort of that backdrop of the equity market's likely to continue to push higher over the next few weeks. But the next sell-off in Lendlease, you want to stop and have a think about adding this to your portfolio if you don't already hold it. If we do see it trade up towards $20 and then correct back down to around $17, at some point in the new year, you're going to see another algorithm buy condition. We think the long-term story for Lendlease is looking attractive, especially in light of the contract that they've won with Alphabet, with a 23 billion US dollar housing development opportunity in the US, as well as the returns coming through from Barangaroo in Sydney over the coming years. So the outlook there for Lendlease looks attractive for us. Mirvac, a number of fund managers are starting to get more bullish on Mirvac. We've just had a recent algorithm buy signal there at around $3, pushing $3.20. I've got Mirvac trading on around just under a 4% dividend yield. Medibank, so we actually like this from an income standpoint for portfolios. Trading on a 4% forward dividend yield, probably not too much in the way of earnings growth, but owning it and selling the $3.50 covered call makes sense to us. Macquarie, just over a 4% dividend yield. The company's guided towards flat or slightly negative earnings growth on the same time last year. But I think that's actually a reasonable, okay outcome. Macquarie's had a number of one-off items in last year's results that delivered a strong profit result. If Macquarie moves sideways around this sort of 130 to 140 level, that seems reasonable to us. Again, owning it and either just trading out of it on a push up above 135 up to 138, just simply trade out of the stock, or just sell covered calls to enhance that income return. NAB, so I'd like to see a little more downside here before we got aggressive on the buy side of NAB. We last had the buy signal here back in May where it switched from sell conditions to buy. It's now rallied from 24 up to 28. Our preference again is ANZ, but if NAB had a little further downside, we're happy to take a look at that. Newcrest Mining, gold looked like it was putting in a bottom or a support level late last week, and we've started to see the early stage of some buying interest pick up. I highlighted on the blog that around $31 was the entry level for Newcrest. The concern that I have here at the moment with gold is that whilst if the equity market remains strong over the next few weeks, it may hold back the rally in gold, but we are comfortable that interest rates are unlikely to move higher Therefore, it should start to rebuild some confidence in gold. You know, but it may take a little while for this bottoming process to really play out. But Newcrest is in our model portfolio, and we see it valued at around that $31 level. Origin, we like the fundamentals here, and just see a steady recovery in Origin, supported by predominantly the LNG dividends coming through from their investment in Queensland. The On balance, though, the more attractive opportunity for us is Woodside Petroleum. So our preferences at the moment is to allocate towards Woodside over Origin. Orica not doing it there at present. Oil search game preference Woodside. Qantas under sell conditions, a little bit cautious on that. QBE's under buy conditions, so just to put some numbers on the dividends, around a 4.5% yield, and looking for earnings growth in the high single digit earnings growth. Owning it, selling covered calls up at around $13 seems like a reasonable opportunity there for us on a risk reward basis. Ramsay Healthcare, we own this. This is one that we spoke about on the blog and in prior recordings as a buy down here at around $62. There was the algorithm buy signal, now pushing up towards 70. Long term buy and hold here on Ramsay is attractive. It's a high quality set of assets within the healthcare space in Australia, but on a 2.3% dividend yield into FY 20, a lot of the upside's already priced in, so we don't expect it to be to do too much more to the upside, and you can't do anything with call options there on Ramsay, so it does limit the returns relative to other alternatives in the market. Rio, so we like this again, that following the thesis that we're seeing a pickup in Chinese manufacturing, we're seeing a softening in the US dollar, we're seeing money and interest come back into emerging markets. That should be bullish for iron ore prices. BHP Rio will be a beneficiary of it. So buying Rio here and looking for a move, maybe up to at least over $95 in the coming week or two, we think is one of the more attractive opportunities in the market. Not being there at South 32 at the moment. Scentre Group, company still doing a share buyback, 5.5% dividend yield. It's attractive, so we see the stock price pushing back up towards $4. So if you're looking for income in a portfolio, buying this here, looking for a move to $4 and then selling covered calls seems makes sense to us. Stockland's not doing it here at the moment, but will point out that a number of analysts have upgraded their outlook to Stockland and actually see it as one of the better opportunities in the market. We're just not getting confirmation on that from a technical standpoint, so we'll wait for a more substantial sell-off and then take another look at Stockland's. Sonic sort of fits into that same category. We like it from a fundamental standpoint. It is getting expensive. They've been delivering good earnings growth, albeit low levels, but good consistent earnings growth. But it's just a bit expensive up here. We're looking for a more material sell-off and then adding it into portfolios on a pullback. Santos, not doing there at present. Woodside over Santos. Suncorp we're avoiding. We see that as developing resistance at around $14, and we've sold out of Suncorp. Sydney Airport, so we've been bullish both Sydney and Transurban as US yields have sort of ran into resistance, and we'll see money starting to rotate into the upcoming December dividend payers. So some of the REITs, some of the infrastructure names. Sydney at around $9 looks full value though. So at about 4.5% dividend yield, but well supported by, when you think about 4.5% yield on a quality asset coming into the December dividend, you're probably not likely to see it trade too much lower than where it is at the moment. Same with Transurban. I think maybe Transurban could push up to around $15.50 coming into the December dividend. So one of the strategies with these would be to let the share price push a little bit higher and then sell call options on the other side of the December dividend and boost that cash flow up to around 10% per annum. Telstra, we like this. I've spoken about this in detail. We don't see too much in the way of earnings growth. One of the big catalysts will be if the company provides more commentary around splitting away their infrastructure assets from the retail business. But on 4.5% yield, and I think an improving story as far as competition goes, we could see Telstra find support at around 340, push back up to sort of 370, that type of price point, in a strong market over the next month or so. Treasury Wine's avoiding that at the moment, as with Vicinity. Westpac has just switched the buy conditions at the end of last week, and around sort of $27 to $28 we see support developing there. So ANZ and Westpac, two that we like at the moment within the banking sector. Wesfarmers, been a little bit cautious here on Wesfarmers, and we're mostly of the view that it's up against resistance where it is at the moment, and we'd like to see a little deeper pullback before doing anything too aggressive there on Wesfarmers. Woolworths has been under buy conditions for the most part of the last 12 months. We had a buy condition there at around 27, again confirmation here at around 31, now pushing 37, but it is very expensive. On less than a 3% dividend yield, we don't see too much more upside there for Woolworths, and would want to pick that up at lower levels. Woodside Petroleum, so if I think about the stocks that we're high conviction on, you may like to take a note of these: Amcor, BHP, Telstra, Woodside Petroleum, which is up on screen here at the moment. Oil prices were strong in the US on Friday night, and we see Woodside being able to trade back up towards around $35. So our real sort of bullish thesis in the market is strong iron ore, strong oil prices, and a recovery in Amcor and Brambles again as a income play for portfolios. But Woodside bullish on, and we'll continue to track that on the blog. And so just to conclude with a short-term outlook on the market, global equities, the real growth story remains technology. The large technology companies in the US, cloud service, delivering good growth, technology around healthcare, defense, security. So we see areas where investor sentiment remains quite buoyant or bullish. Right at the moment, this sort of swing back towards emerging markets is likely to set up more buying for equities as we start the week. And therefore, we're happy to have this exposure at the moment in the names that I mentioned, but we're mindful that some of the US leading indices have sell signals, but our sort of leading light at the moment remains the Nasdaq, which is under buy conditions. So we remain bullish equities whilst that technology theme continues to be something that the market gravitates towards. Thank you for listening in, and if you'd like to have a discussion around our premium account service, please call me on the 1300 number on screen there, 1300 614 002. Thanks for listening in.